Well, welcome everybody. We're going to have a chat today about due diligence. So we've spoken so far about valuation, and I can't remember what we talked about last time. We spoke about valuation, and now we're going to move into due diligence. So you found you found a deal, you figured it's the right price, you've got to the letter of intent stage, and you've got an accepted offer. Now the next step in the process is to go through due diligence to make sure that you're buying what you think you're buying. And so we talk about due diligence a lot in around the idea of trust but verify. So for most business owners and most deals that are represented by a broker, the information that's provided should be accurate, and we're pretty confident it is, but we don't go and do a deep dive the same way that a buyer is likely to do a deep dive to ensure that everything is as presented. So Liz, from your perspective, what are you coaching your buyers on when they're starting the due diligence process?
Really, we coach them that this is the confirmatory part of the process, and a lot of people will also kind of get stale before this process. They'll get shy to put in a letter of intent because they feel like it's now everything's set in stone and I'm going to be moving forward to buy this business. But what we really coach them on is due diligence is confirming that was presented to you is true, and that you can gain the comfort that you need to actually go through and acquire this business. And we teach them that it's a stage in the process that that certainly is not to be overlooked or rushed by any means, but definitely like treat it like a stage, and it's things can still change, that lots can change during due diligence. And I think once they wrap their head around that and how things can change during due diligence based on the findings, they can move through it more easily, seamlessly.
I agree. So we're talking about the same, we're given the same advice, I believe. Yeah, so due diligence is you're basically looking at all the aspects of the business and making sure that it's going to meet your needs and making sure that everything that has been talked about is true. So there's 5 key areas to investigate. So we'll go through them more in detail further along in the presentation, but it starts with financial due diligence, legal due diligence, operational due diligence, and then a bit more on the macro side, the industry and the market, the industry and the size of the market, the total addressable market, if that's what you're interested in. And the final thing that I don't think enough people focus on when doing their due diligence is the HR and the culture of the company, that you want to make sure that your values and goals align with the company themselves and the culture of the company. I don't know, Liz, do you guys talk much about culture when you're?
We have some advisors that we lean on for those pieces. So we did a webinar not too long ago with a group called Stacked Consulting out of Calgary, and it's a really fantastic listen. If anyone needs the recording, happy to share, where they talked about culture. So we've had guest advisors in to talk about culture. The HR piece really, really critical around, what are the current benefit plans, whether someone's buying as an asset sale or share sale, how does that change the treatment of employees? That's where usually the culture conversation will start in terms of like contractually, and then it kind of peels back like an onion from there. Is like, okay, well, how long have these people been here? Why are they staying? Why are they choosing to stay? What's important to them? How are they going to perceive this transition? And it kind of, you go deeper and deeper from each kind of piece that you're looking at.
Yeah, I like that peeling the onion. I think that's a great analogy for what you're doing here. You start out sort of pretty broad, and then you move into the more detailed as you get farther into it. And each time you sort of peel a layer, it's because there's questions that have been raised from the layer before that. You want to switch over to the next one there? So the financial due diligence component, and this is really where you spend a fair bit of time. I think most buyers spend the most time looking at the numbers, just making sure that they're real. There's a few key parts of the financial due diligence that I think buyers themselves can really sort of focus in on. Are the numbers real? And I think in most of the Canadian transactions that we've been a part of, the numbers are pretty much always real. There's very few sort of fraudulent, there's very little fraudulent information. I do hear when talking to brokers and buyers in the United States that situation is sometimes different there. But because most of the transactions that we're involved with, they have CPAs and they have financial statements available, those are generally pretty accurate and don't get questioned too much.
Yeah. We've seen a couple of instances where the financial reporting was accurate, but some of the decisions that the previous owner made impacted if they were ever to be audited or tax treatment. So, for example, I'll give you one example. We had a situation where there was two companies, one in Canada and one in the US, and the owner of the company in Canada, where the headquarters were, was an accountant. And so he wasn't using a third-party accountant, and he was filing his own taxes, and he had filed, he hadn't totally filed in Canada and the US accurately and where his revenue was coming. And it came out that the company actually needed to refile their entire taxes, and it was going to trigger a tax liability. And for that was one of the reasons that the deal fell apart and it didn't go forward, because it was insurmountable from the buyer's perspective. So sometimes we see stuff like that come up. I've seen another situation that came up where and this one was years ago, because I used to be a broker before I got full on buy side. I saw it where the business owner had previously attempted to franchise and had taken substantial loss in the franchise company, but had written off that loss, like over $300,000 of loss in the operating co. And the accountant had put it there, and then realized that it shouldn't be there. And if a buyer was to come in and acquire the opco, that and as a share purchase, that was not the way it should have been filed, and they would have been liable for that. So the business owner in that situation had to refile. So we see stuff like that come up a lot.
Yeah, I would say the other thing.
I shouldn't say a lot.
Yeah, the other thing on the financial side that I've seen that has changed the deal structure is around the fact that sometimes in the small business space, the owners are really sort of trying to minimize their tax burden, and sometimes they'll run stuff through the company that may not have been the best decision to run through the company. And in those situations, if there's a lot of that, there is definitely a risk on the buy side when it comes to doing a share sale, because all of those decisions that have been made by the previous owners are going to carry forward to the new owners. And in that situation, the perceived liabilities or the potential liabilities become too high to do a share sale. So we've had to switch to an asset sale on occasion in that situation, where the books are just too messy and there's just sort of too much hair for the buyer to comfortably take on that liability, even though contractually the seller is responsible for that, but it is trying to collect on that responsibility it can be a challenge. So we've seen that happen, and I think maybe it'd be a good time to let people know that this is designed to be an interactive live stream. So if you have questions, you can put up your hand or start saying something in the chat, and we will respond to questions as they come up.
Yeah, or if anyone here has seen something that was quite interesting, feel free to share that. I see a couple of familiar names, Jesus and Dale there. So I know you guys have been around the ringer for a while and have stories of your own.
We do have one question here. How important is it to request audit financials versus NTR compilations?
Good question.
It's a good question. It depends. Typically, the audit, if you're talking about like audited financials, not very many small business owners are going to spend the $25,000 to $30,000 to get audited statements. You're probably referring to review engagement statements, is my guess, which is the second most comprehensive way to review financial statements. And if you're working, some banks require that in order to get the financing done. If that's the case, then that's a legitimate request. I don't think from a due diligence point of view, if you don't need a financing, that it makes very much difference. We've seen, I don't know how many of these things go from compilation to to review statements, and nothing really changes for the most part,
Yeah.
from what we've seen anyway.
Yeah, I would say where we see it is if the loan, and it depends. So recently we've heard if it's BDC who's doing the loan and the borrow is more than 350,000, then they would require review engagement statements. For a number of the other financial institutions, usually it's in the low millions where they would require that level of financial statements. So and then it's always, well, who's going to pay, which party pays for it, because if one buyer is going to need it, then any other buyer is going to need it too. So it's part of the sale in one way. I don't know, Keith, have you seen it be a dialogue between a purchaser and a seller who pays for, if another standard of financial statements is required, who's paying for it?
Like everything else in our business, Liz, it depends. The way that if it's required, the way that I try and work that into the deal is that if we do the review statements and the cost is say $10,000 for that, if the purchaser goes ahead and completes the purchase, then the purchaser will pay for them, or then the seller will pay for this. The purchaser will pay for them. If they've changed and materially changed, and the deal doesn't go forward, then the seller would pay for them, because they'll be able to use those for their next transaction if this one fails.
That's fair.
Yeah, so that we've done it a couple of times, but it's not super common. We try and coach our side clients to, especially if the deal's large enough, to go ahead and spend the money themselves up front in order to basically just improve the likelihood of a deal closing.
And will they often do that before you go to market?
Yep.
Nice. No, that's great. Sorry, go ahead.
I was going to say often is a strong word. They will, if especially if we're looking at a deal where we know the BDC is going to be the likely financer. We just did one for a small business where we convinced the seller to go ahead and do that because we knew that nobody else would. They're the only real financier for something of that particular business. So.
Yeah, I want to just come back to Michael's question before we move on too far. He mentions NTR. So if anyone's not familiar, that stands for notice to reader. But that level of financial statements has also the naming of it has changed. So it's now referred to as compilation engagements. So it's compilation engagements and then review engagements and then audited financials. So depending on the size of the company and the size of the loan the borrower will require can sometimes dictate what standard of financial statements are required.
Yeah, and as the businesses get larger and they start using different financial facilities, a lot of times there is a requirement by the bank to have review statements anyway.
So have another question. Oh, sorry, Keith.
Go ahead.
Jesus says, hello, if there's tax exposures or risks identified, but it is uncertain doing due diligence, can indemnities in the purchase agreement protect the buyer enough so that they can move forward with closing the deal? I know a lot of this will depend on details, but just curious if anyone has general thoughts on this.
Yeah, you're contractually you're fine. Like the indemnity clauses that are built into the agreements make it so in almost every case that the seller is going to have to be responsible for any of this stuff. But in the reality of the situation is that if a tax audit happens 3 years later, 3 years down the road, the business has been sold 3 years later, for whatever reason, the CRA takes another look at it and then does their audit, and there's outstanding liabilities belonging to the old owner, then tracking down the old owner and trying to get him to live up to those contractual obligations could potentially be a challenge. So you are protected contractually for sure. It's just, when the rubber hits the road, are you likely to be able to collect on that indemnity?
Yeah, if it needs to go, if reps and warranties, protects you, but then you have to go to litigation to get it back, then you're balancing, what's the cost reward here. So ideally, those tax risks that you've identified them and quantified them during due diligence. And then if something can be, remediated closely after closing, sometimes that's where you might use a holdback, and that they're responsible for certain post-closing obligations, and then subject to those obligations being met, then the holdback will be released. So you can tie certain clauses to your holdback or other terms.
Yeah, totally agree with that. So, and the next thing we're talking about is quality of earnings, and Michael had a question on that, so we'll get to that in a second. And then working capital is the other part of the financial due diligence. So on the Q of E side, the question is there a standard price range that you see in the market? This is another big it depends. There's a lot of firms that do Q of E work, and the prices I've seen range from like 10,000, and I haven't been party to any of this, but I've seen them. I know that they can go over $100,000 depending on the complexity of the business and who you're using to do your Q of E. Like if you're using Deloitte, the number is going to be pretty large, and if you're using sort of a smaller local accounting firm or somebody that specializes in it and and they do smaller deals, then you might be in that sort of $10,000 range. Have you seen anything smaller or bigger than that, Liz, in your?
Yes and no. So I'd say, like, and to Michael's question, is there value going with Big Four for Main Street deals? I think you have to match your advisor sophistication and quality sometimes with the size of the deal. I think, if you're doing a Main Street deal, do you need Big Four? There's lots of quality, smaller firms like in that smaller bracket, like Baker Tilly, M&P, Grant Thornton. They would be kind of the next layer, and then from there there's smaller, more localized firms that are often run by people who have left Big Four firms. Like, they're out there, people who have left Big Four firms who can do it around, what Keith had kind of quoted, around the 10,000. And then we have seen a firm as well offer to do kind of a special assessment, and so it's not a full Q of E. So if you need a Q of E for quality of earnings for the bank's purposes, like, you just need one. But if you're doing it for your own comfort, I have seen firms do that special assessment, and they'll poke where necessary to poke, but they don't necessarily need to do everything.
Yeah, and I would say we've been working with a company called TreeWalk. They're based out of Vancouver, I believe, but they do Q of E all across the country and North America as well, and they're pretty cost effective. So if anybody wants the contact information for Avneet at TreeWalk, I'd be happy to provide.
And we use one of the firms that we use a lot is they're also in BC. They're called if people want two options, Pacific Advisors. They're good too.
Yeah, and they do smaller deals as well, Liz?
Yep.
Yeah, perfect.
Yep.
Then we can talk about working capital, everybody's favorite topic, I think. So part of the financial deal, and this is where it sort of gets challenging from a broker's perspective, I would say. In the sort of small business space generally, working capital isn't normally included in the purchase price of the business, except for inventory. And I know every buyer wants to see working capital included as part of the purchase price. So if it's not included in the offering, and you want it included in the price, you're probably gonna have to raise the price. I would say, by the value of the working capital, if you want that to be a part of your deal. If it's for our stuff, if we think the business warrants working capital, we'll include it in the price of the business, and we'll specify how we got to our target working capital. And buyers are free to disagree with that, but I would really sort of check the advertising and check the information that's being provided as a buyer to make sure you understand what is being offered as part of the sale of the business.
Yeah, we do like to see it in the deals. Like, there's what small businesses are common to do and not do, and we get a lot of pushback from some of the brokers that we work with that no, it's not included. Everything's a negotiation. We make the analogy that it's kind of like when you buy a vehicle, that you don't come to the dealership with a jerry can and then fill up the jerry can to go drive to the gas station. Like there's a little bit of gas there to get you from point A to point B. So we always lean on the accountants for the working capital requirements as well, and we like to see their analysis of what's actually required here for a bit of working capital to get going, and they can be calculated in a number of ways.
Yeah, for sure. We are, the way we generally do it is just current assets less current liabilities, removing all the cash from the equation, and then sometimes we'll do like a cash conversion cycle to see if that sort of matches with the balance sheets. And by combining those two pieces of information, we feel like we kind of get it right most of the time, but it is something that as a buyer, you're going to want to make sure you really understand the working capital needs of the business, whether it's included or not. So you have enough, so you're not running out of gas on your way from the dealer to your first gas station or your first sale. So definitely you want to be considering that very thoroughly.
Yeah.
Want to move to that? There we go.
Yeah.
So,
did we answer? Marcy had that question there, Keith. I don't know if you wanted to speak to the term.
Yeah. So again, Marcy, the answer is it depends. So if you're buying a convenience store, your working capital needs are going to be very, very low because you're buying stuff and you're getting cash as you sell things. So your only working capital needs are likely in a convenience store inventory and maybe enough to cover the first payroll or the first month's rent. If you're working with a different kind of firm, like a business to a B2B kind of a firm, where there is 60 or 60-day receivables, 90-day receivables, then you're really going to want to dive into that. And having enough money for 3 to 6 months isn't generally how we can think about working capital. We more think about it from a more financial kind of way, I guess, using the balance sheet and the cash conversion cycle. But for a simple rule of thumb, I think for most small businesses, having 1 or 2 months of cash to cover the expenses going forward is probably going to suit your needs if you're buying sort of less than $1 million.
Yeah, it's case by case, and really depends on the type of industry, the industry as well. Yeah, there's not one way to look at it.
That's for sure. When we talk to lenders, it's the same kind of thing. They'll assess it on a business by business case. They just want to make sure that you're not going to go broke in your first month or in your first 3 months.
Yeah.
So we'll move into the legal and tax due diligence. And from our perspective here, this is the kind of the easiest one for us. And typically it's pretty easy for the buyer because you just sort of pass this over to your lawyer. And they'll send out the correct documents, make sure that the corporation is structured correctly, everything's been filed correctly. When it comes to the NCRA compliance, same kind of thing. Your accountants will mostly handle that. The liabilities and legal risks are sort of a different kettle of fish. And this is where you sit with your lawyer, and your lawyer generally, I don't want to say tries to scare you, but they'll bring every conceivable risk to the table, and you'll have to, as the buyer, go, yeah, I think that's something that we're going to try and mitigate through the purchase and sale agreement, or the mitigation risk or the concern is overblown, so we're not going to do anything with that. So I think most buyers that walk out of their lawyer's office after their first meeting are a little shook with all the things that could go wrong when they buy a business.
Yeah, a good M&A lawyer will come at it from a solutions focus. Like they'll identify, like, here are some of the risks in buying this business, but here are some of the solutions that are available to you. It's like, if we lean on this clause, or if this happens, this would protect you here. So make sure, really, it's so important to be working with the right lawyers. Jesus, I saw your comment about the lawyers and the legal in due diligence. Do you need the bigger firms? Like, no, not necessarily. No, you don't need to have a massive firm working with you just because they have the right, name on the door. There's lots of great small business M&A lawyers that have decades of experience. It's just like you just want someone who has experience and does it, I would say, on a regular basis, because things change in this industry. So if they were an M&A lawyer, 10 years ago, but now they do one every couple of years, like, are they the best fit for you? Maybe not. You don't necessarily want to be using your residential real estate lawyer to do your acquisition. Make sure that they have the experience in the space. I can't stress that enough.
Yeah, we had one a few years ago. She was starting out her legal career, and so she was acting. I believe she was acting for the buyer. I feel like that. Maybe no, she was acting for the seller, and she was charging the seller for research. Like basically, she didn't know what she was doing, so she was learning how to do it along the way, and then charging her sort of learning time to the seller. So I think you definitely want to find somebody that's done a number of these deals in the past.
And get clear on how they bill too. So some, some have a retainer, some don't, some are success fee based, some, just get comfortable with how they bill, get real. And then the other thing I would say is, like, as you're working with them, like if you've got a legal budget and they agreed to it up front, like check in with them, be like, hey, how are we doing for our time here? And try, don't ever avoid them. Like, they are there to do their job. But if there's something that you can, something that comes up and you need to talk about it with the business owner, try and go to the business owner and don't go to your lawyer and they'll go to their lawyer, and like, because that'll increase fees when it's something that you could go directly to the business owner or the broker on, resolve it, and then inform your lawyer and then get there, but it's a sensitive process all around, is pricing. So I don't know,
Yeah.
Keith, do you have any comments on that?
Well, 100% agreed on get a quote up front. Most lawyers will say, like, I think I can do this for $20,000, but I do charge $650 an hour. But as soon as they put that base number of what they think it's going to cost, they mostly try and stick to that. If you don't get that up front, they're just $650 an hour for as long as it takes them to do the deal. So your $20,000 budget might be $40,000 at the end. So we strongly suggest that everybody gets a quote before they start. And and I do think that as you start moving forward in the due diligence process, you don't really want your lawyer to be negotiating every point on your behalf. You really want to sort of work with your lawyer right at the outset and understand what are deal killers and what are things that we're willing to sort of work with or give in to, and make sure that you really understand where your deal killers are and stick firm on those things, and then everything else can be sort of worked around.
Yeah. And I would say in the relationship with your lawyer too, like, don't let them drive the relationship. You're the client, they work for you, and you have to be assertive in that relationship. Because if they in some situations they will, just drive the car and take you wherever you want to go, and it's like you're in the driver's seat, you're in charge. So really good to understand if you own that relationship. There's a great book. I'll see if I can find it here. It's a really quick read and you can find it on Amazon. And the guy was, you might know him, Keith. Do you know Terry Lammers?
I do not know.
I met him at one of the IBBA conferences, and he did a roll up himself and then became an M&A advisor. And he's got a great little quick book, and he talks a whole section about working with advisors and working with your lawyer, and it's really great advice. I'll see if I can find it here before we end today.
Yeah. So we moved over to the operational and asset review. There we go. Yeah, so again, depending on the business, this is the one that's going to change probably the most from business to business or deal to deal. Understanding how the business actually makes money is key, and that's what the operational asset review does. So you want to look at the key processes and systems. You want to understand who the suppliers are, who the customers are, understanding what equipment is required for the business, how that equipment is purchased, and how often it gets replaced. So if people are not familiar with maintenance CapEx, this is where that idea comes in. So if a business has got $1 million worth of backhoes, and it's got 10 backhoes, $200,000 each. How long does it last? How long do I have? How much is going to cost me to replace them? And then you're going to have to sort of build that maintenance capex into your budget, into your go forward budget, because that's going to impact your cash flow and your ability to repay your loan and repay yourself.
Yep. And any lease agreements, like those are ones you like review them meticulously, because sometimes those agreements have assignment clauses where they can't be assigned to third parties without permission. So then you have to get third party permission to take over some of those leases. Things like insurance. We just recently had a deal where the insurance couldn't transfer as quickly as they needed it to. It was going to be like 4 to 6 weeks to transfer insurance or something. And they were like, oh my gosh, we're supposed to close in 2. And that needed to get resolved. So contracts around anything of these need to be reviewed. Supplier dependence as well. And this comes in especially now with tariffs, is like the business that you're buying may not be impacted by tariffs, but what about your customers or your suppliers? So right now I'd advise, like, or suggest that go deeper in your supplier and customer due diligence to find out how would they be impacted in current economic times as well, and look at that 2 degrees, 3 degrees of separation away from what's happening economically right now.
Yeah, that's huge right now. And with one of the things that I'm thinking about as we onboard new clients is actually to put a page in around sort of tariff impacts, and help the seller or the potential buyer understand what the seller's understanding of the impacts might be. The other thing on those, oh, sorry, go ahead.
Keith, when you mean add a page, do you mean add a page in this your selling package, your SIM, or yeah? Okay.
Yeah, just I think it's a new reality, so we just have to address it and try, and like it's kind of our job as a broker to try and get in front of as much as possible. And this is one of the things that is, as we're seeing, that it definitely has impact on the saleability of a business and the price of a business. The other thing I wanted to mention was the supplier, like transfer and supplier relationships. It's generally pretty easy, because your suppliers are going to want to continue selling to you, but a lot of times a seller will have signed a personal guarantee with a supplier, and they may have signed it 15 or 20 years ago and forgotten all about it. And then as you're reviewing contracts, you might see a 15-year-old contract with a personal guarantee from the seller, and if that happens, you kind of want to get in front of that as quickly as possible, because that same supplier will likely want a personal guarantee from you, even though they've been doing business with that company for 15 years and nobody's thought about it in 15 years, but they'll think about it again as soon as there's a new owner.
Yeah, hopefully you can avoid signing personal guarantees with suppliers, but it does come up. But hopefully after 15 years they're taking the goodwill and the company. Yeah.
Yeah, it depends on the size. A lot of times it depends on the size of the supplier and their internal processes.
Mm-hmm.
And so they may have an internal process that, if you're selling HVAC components, Train may have a requirement that a new owner has to sort of supply a personal net worth statement and go through the same hoops that the original owner did many years ago. It doesn't always happen, but it's something to definitely keep an eye out for.
Yeah. And sometimes those things can just be annoying and slow down the process. And in the end, they're, it's not a mountain, it's a molehill.
Yeah, it's in the network, in the universe of one more thing. There's when you're trying to close a deal, there's always one more thing. And the supplier contracts are a lot of times sort of left till the end, and they don't often, I don't think they've ever killed a deal, but they do sometimes cause delays.
Yeah. Michael has a question there.
It's a dependence. If there's a dependency on one segment of a customer or vendor, how would this impact valuation? Or is it a matter of structuring a VTV, potentially earnout to protect a buyer's interest? I think the answer is yes. So if there's you should know if there's a owner or supplier dependency when you purchase before you write an LOI. I mean, that's something that should be sort of outlined in the SIM, or the buyer or the seller should have talked to you about that. So the price, so it should already be priced in. I guess the only time it wouldn't be priced in is if you didn't know about it. But I think it would be kind of hard for a buyer not to know if there was a particular sort of, supplier dependence on a deal. I know.
You'd be surprised. We see it a lot.
Oh, really?
Not all brokers work like you guys do. Or if people are finding deals off market that haven't been scrubbed by a broker. I will say, like, a good broker will like, they're careful about what companies they take to market and they take on. If they see really hairy structures or improper filing stuff, oftentimes, like, I'm speaking on your behalf, Keith, like, they'll say, I'm sorry, like, we're not going to take you on as a client, or we don't feel like we can sell your business. So, like, there is some level of checking, but we'd see it a lot, Keith. And I'd say if customer breakdown is not provided to you as a buyer in a SIM, you need to know to ask for it, because it's not always disclosed. It's one of the questions you absolutely have to ask.
Yeah, it's definitely it's definitely a huge value driver. So if you don't know about it, if you're offered, say, 4x on a business, and then you find out that it's only got one customer, it's very unlikely that that business is worth that much, unless there is some type of a strong contractual relationship with that client. Yeah, so it may lead to a retrade. I didn't really want to talk about retrading until we kind of got near the end, and how much we hate retrading. But sometimes there's a reason for it, and due diligence is generally where the idea for a retrade comes out, or a restructuring of the deal. Yeah, and if you can definitely protect yourself with not so much with ETB, but more with some type of an earnout structure, would give you the most protection against the supplier dependency. Yep. There are brokers and there are cowboys out there. Feel like a cowboy. Feel like a cowboy today.
Yes, there are, Rolf. It's still an unregulated industry for the most part, so you have to be careful as a buyer.
That's why we do due diligence.
That's why due diligence exists. Yep.
Yeah. So the people and the culture component, again, this is something that, probably, I think buyers will do this sort of informally and not through a formal process very often. I think they'll tend to look at employee contracts, because they're pieces of paper and you can look at them. Mm-hmm. But the culture fit and who runs the business are questions that are typically sort of handled in conversation more so than in sort of document requests. You sort of seeing the same thing there, Liz?
Yeah, more conversationally, and a lot of the times they won't let you meet with the employees until a certain stage, but there are questions that you can ask. Ask what's done for the employees, what non-monetarily, compensation wise, aside from their compensation, what else does the company do for employees? How long have employees been with the company? Like, if you see a lot of turnover, that speaks to culture. It'll be a trigger on culture. So you can pick up on subtle cues by asking, some of those questions, like, yeah, how long have people been there?
Yeah, we had an interesting, a couple of interesting things. So you talk about the seller, about the not being able to meet with personnel, right very close to the end. That's our standard process, is once all the other components of due diligence are done. So you've got your financing, you've got your landlord approval. At that point, you can start in our system, in our process anyway. That's when you can start talking to the key employees, and typically we'll want to have that conversation with the owner present, if the owner wants to be present for that conversation. We just ran into one recently where the owner told their employees that the business was for sale, and the employees have known about it for a while. So the first buy-sell meeting that happened, is this, the sellers basically came for, or the employees basically came forward and asked and told our team that they wouldn't go forward under a new ownership unless their wages were almost doubled.
Oh, wow.
Yeah, so there's that's the risk that you take as a business owner by telling your employees that what's going on is, sometimes things like that can come up. So we're trying to sort of muddle our way through this one now. We'll see how it goes.
But do you think that would have been avoided, Keith, if would they have done that anyway, even if the deal closed and then the new buyer, well, I guess it was an asset purchase or a share purchase?
I I believe it's a share purchase. I don't know for sure though.
Yeah, so normally the employment agreements will transfer if it's a share purchase. But if it's an asset purchase, you as the buyer have to make sure that you have new employment agreements with the employees. So that can like trigger that reason to meet them sooner than later.
Yeah.
So that's interesting. Do you think it would have happened anyway, even?
We talked about it a bit, and I think time sort of gives people, like that much time gives people sort of lots of, or too much time to think about it. Like if you meet this new owner sort of 2 weeks before close or a week before close, it's like, oh, I've got a new boss and I'm going to start working with him, and you're not thinking about how I'm going to maximize my return, as an employee, like for 3 months, and 3 months of sort of consideration, I guess, led to this. But I don't know. I mean,
Yeah.
I don't know what would have happened, but
yeah, very true. And there is we've seen it too where someone was like they were buying and the employees weren't told and the deal had closed and the owner said, or the purchasers said, I think what happened, they said that the owner's going to tell them on a Friday and we're going to meet them next week. And I was like, whoa, whoa, whoa. Like, I recommend that you wait the weekend, have the owner tell them, and then you guys be there the next day, because don't leave that time. Like, and we were talking about a weekend, but they've got to kind of know who's coming in right off the bat. That time, that time, too much time to think can cause a lot of anxiety in employees.
yeah, nobody likes uncertainty, and and a lot of employees are employees because they want the stability of that. And so as soon as they feel like that relationship with their owner is unstable, then they start thinking about other things that they can do with their time and start looking for other jobs potentially. So yeah, in my view, the best way to do it is to have the business owner, if you haven't told your employees, is to have the business owner come in and introduce the new owner. And they can come in with new employee contracts, but typically you just want to say, thanks so much for all the work that you put in. We've had a great success in being a buyer for a company. Meet John, he's amazing, and let him tell you about himself. So I don't think there is any specific right way to do that. But and as a business owner, you probably know your employees better than anybody else. And as a business buyer, I think you should kind of just take your cues from the owner on that transfer.
Yeah,
but
I agree, Keith. There's not necessarily a right way, but there are certainly some wrong ways. Overall, just it should be a very thoughtful consideration and certainly not just kind of overlooked.
Yeah, and when I mean, everybody sort of really sort of hones in on the employee contracts, and everybody wants sort of as a new owner, they want to have the right employee contract in place. You may have hired an employment lawyer to draft it up for you, but I think there's nothing that scares an employee like meeting the new owner and having a 16-page employment agreement written in legalese put in front of them and say, sign here, and I'll give you a gift card to Arby's or whatever. I think you really want to be very careful about alienating employees as you take over a business, because ultimately they're, in almost any business, your employees are probably your biggest asset, and alienating them at all in that early stages is going to create a system or a culture where you're not going to be in the best space as a buyer.
Yeah.
Hey, Liz, can you drop the link for people to register and check out the valuation tool on, we had a couple people ask for the links on how to get into the Village Wellth sort of community hub. You can just-
Yeah. Sarah is here with us too.
Sure.
So, yeah, they can just go to villagewellth.com and then sign up, and get in the marketplace for free there.
And we have a couple other questions. Roger is asking, what are some good rules of thumb to keep in mind? So like look at only businesses you can afford to purchase with 20% of the cash as a rule type thing, or you only want to look at businesses that have X years remaining on their lease, etc. I'm generating more and more cash from my current business, and I'd like to continue to invest in businesses and accumulate wealth that way, but I have no background acquiring.
That's a big question.
Big question. Roger, we'd be happy to chat with you. Our team just supports buyers. Sarah's email's there. There's lots to learn, but I do want to pull on one thing, and Keith, feel free to answer some of the rest of the question, but I will certainly pull on one thing that relates to this conversation is the lease. Like, do you only want to look at businesses that have X years remaining? As long as there's an option to renew or an extension on that lease, but it is really important to know that if the business is reliant on its physical location and there is a lease in place, that the banks require that the term of the lease be at least the term of the business loan. So if you're getting a loan for 7 years, the lease in place has to be that term length, or it has to at least have that extension ability. So that is something really important for getting your loan, is it's tied to the lease.
Yeah, definitely. We've seen that time and time again. And one of the biggest challenges in due diligence is actually getting a landlord to respond in a timely fashion.
Yeah.
It's one of the things that delays deals is landlords just not responding or being very, very slow in assessing a buyer to make sure that they're going to qualify to transfer the lease or to have the lease assigned to them. So
Yeah.
we try and work with our sellers to have them contact their landlords as soon as it goes up for sale and say, hey, this is what I'm doing. What's your process? Who do I need to talk to? What documents does a buyer need? And then we can sort of build that in as we get buyer interest, and as we get to an LOI, then we can make that introduction as quickly as possible to try and sort of get to not have that be a deal killer or a deal delayer over time.
Yeah, we coach on that as well. So we say, the bigger the leasing company, the longer it's going to take. So if the property is owned by, maybe the owner and they're going to lease it back, that's fine. If it's owned by, someone local and they just own the real estate, that's usually fine. But if it's owned by like a very large property management company, or there's the property is owned by someone, overseas, and they're dealing with property management company, those layers of communication add time, and we have definitely seen lease agreements slow down and not kill a deal, but just it pushes out closing, and they don't close on time.
Yeah, we've seen the landlord kill deals for sure. Just not accepting buyers. They've qualified for financing, but the landlord, for whatever reason, doesn't like their credit application, and they just decide that they don't like this person or don't like the buyer, and they just say no. And at that point, then the deal is almost invariably dead.
Yeah, I've seen it once. Yeah, and the buyer was buying a business with cash, or they did like a home equity loan on their mortgage, so they didn't need traditional debt, but they had filed for bankruptcy, and the landlord caught it, and they were like, no.
Yeah, that's. Do you talk to your buyers about pulling their own credit report before they start the process, so they understand what's on there and what people are going to see?
Yeah. This was like 8 years ago that I saw this situation. Yeah, this is not recent, by the way.
Okay. No, I'm just wondering, just as part of your internal process, Liz, if that, like it didn't even occur to me until you started talking about it, but I'm just wondering if that's something that you do.
Not up front. No, we look when we're involved in the debt process. because we will help people apply for their financing. We're looking at it at that point, but it depends how we're involved. Yeah.
Yeah, because it's one thing as you know, for the business buyers that are listening in right now, your net worth and your credit score are going to be looked at by a number of people during the course of the transaction. So if there's something on there that's incorrect or that's you want to get that fixed before you show it to your first lender or your first landlord.
Yeah, they are looking at your character. We did a session yesterday, and Eamon, who works on our team, and he's ex RBC, and he said, you know, when you're buying real estate, the banks they don't really care about who you are, and they very, very much care about who you are in acquisitions.
Yeah, and we'll also look at your past history, your work experience, because they're betting on the business, but they're really betting on you when it comes to repaying that loan. So the better you can look, and so having an up-to-date CV is probably another good practice for business buyers, so that when a bank asks for that sort of standard information, it's already there and you can just supply. Is that the last slide, Brianna? Or we
Like, why is it called a CV anyway? Like, what does that stand for?
Curriculum vitae.
Curriculum vitae.
Oh, really? It's a real,
Latin.
okay. Like, I've heard CV used for resume lots, but I had no idea what it was for.
I think it's Latin for resume.
Really? I'm gonna chat this after this.
Yeah, you find out
All
what the
about
Latin meaning looks like. I see Miriam's question there, and this is the book by Terry Lammers. Oops, let me see. There it is. I am a very slow reader, and I read this while at an airport once. So that's like how quick a read it is.
That's my kind of book. And so I think this is our final slide on the due diligence components, but industry and market factors. And again, this is really not so much a due diligence on the sell, like, you know, the seller's not going to provide this information for you. This is research that you're going to want to do yourself. You know, is there macro risks in the industry that you're buying? Like, you know, tariffs have come up, and like, is the business that you're buying going to be subject to tariffs to ship to the US, or vice versa? Is your supplier going to be hit with tariffs, and your costs going to go up because of that? So you want to take a look at those kinds of things. You know, you kind of also want to take a look, sort of, if you're buying a business that, you know, may have some headwinds coming against it from a regulatory side of things. And the competitor landscape, you know, typically, like like for us anyway, we'll put a competitive landscape in our sim. So then we'll identify 3 or 4 different competitors in the space, but there's always a lot more than that. And sometimes the competitors that you think are important are not the ones that are important. It might be like Amazon might be your biggest competitor, and not, you know, the other you know, shoe store down the street, right? So you really got to understand what kind of industry you're buying into, and what are the headwinds that are totally outside your control.
I would also, as a headwind, like, pay attention now to how technology is impacting. If you're looking at a business, how is technology impacting that business? What are the risks and advantages? Because AI is impacting, you know, service-based industries, and you know, it could be to the advantage, or it could change a business's pricing model entirely. So pay attention to that as well.
Yeah, for sure. We're looking at, like, even some businesses that are, you know, are sort of ahead of the curve on stuff. So if you're looking at like an HVAC business or a home service business that puts people on contracts, so you've got that they've turned it into a recurring revenue model, that business is likely to be worth more than the competitor that hasn't done that yet. But as a business buyer, if you identify another HVAC company that hasn't put those practices into place yet, then you've got another lever that you can pull to increase revenue and increase the value of the business relatively quickly by implementing stuff that other competitors are doing. So do a lot of industry research, see where the best practices are, and if your target isn't implementing all those best practices yet, it could be a great buy for you, because you'll be able to do stuff that's relatively inexpensive and get you to be more profitable or have more sales relatively quickly, which I think is a lot of the ETA sort of playbook is identifying those trends and acting on them quickly.
Yeah. Yeah, well, and a lot, yeah, looking for those industries or businesses that haven't been automated or digitized or aren't using marketing. Like we see a lot of people that do really well have marketing and sales backgrounds, or who we are seeing a lot more people who have tech backgrounds that are really interested in buying an established business, because they know they can bring so much to it. It's really fascinating.
It is, and there's a bunch of businesses out there that the owner, like we're selling one right now. They don't have a website. We sold one, an insulation firm a couple of years ago, that all of the business for the company was done on the owner's cell phone, and he was making $500,000 a year, and they had no email, no website, just a cell number and a bunch of texts. And he was able, and so yeah, so the sale price for that was, the multiple was pretty low. It was like 2 times, I think, it was sold for, and the buyers were tech backed buyers. Like one of the buyers was a executive at Google, I think. And they implemented a sales and marketing strategy that helped the company grow very quickly. So.
I'm just going to respond to Natalia's question here. She said, is it possible to get the recording on this previous meeting? So our marketing team is actually going to send a follow-up email to everybody that has all of the links for all 3 webinars, and then some other helpful links. So, Village Wellth, how to register, your discount code, maybe the book that Liz mentioned, a couple other valuable resources for buyers. We're just going to pool between Liz and Keith. We're going to pool some resources and then send you guys a list so you can look at all the other recordings, and then get some helpful links. So that will
Awesome.
be coming in the following week.
Yeah, I think it's just this one get posted on YouTube. I think
The 2 previous ones have, and this one will as well. Yeah.
Okay, cool.
Yeah, the link will be available.
All right.
And yeah, we with Village in our membership, we do these sessions every Friday morning. So if people want, once this session's over, I don't know, Keith, if you're planning to keep them going, but if not, we do them over at Village too.
Yeah, well, if people are getting value out of them, I'm always happy to talk to you, Liz, and doing it in a public setting is fun too.
Yep.
And so the red flags and yellow flags, I think we talked about this a little bit earlier, and we're getting to the end of our time here, but just understanding what your red flags are, I think is so key as a business buyer. And as we work with more professional buyers in different industries, we're seeing that they can just identify very quickly when a business isn't a fit. They just know what the red flags are. If it doesn't hit their deal box, then they're out and on to the next one. So as most of the folks here, looks like they're probably going to be buying, a single business. Understanding what your red flags are super important, and yellow flags are just anything else.
Yeah, there's a lot that can be overcome if you know how to overcome it. Not everything's a deal breaker, although it may seem to appear that way.
Yeah. Yeah, and always think about mitigation strategies. So, yeah. So I guess, and the last point, I imagine most of you guys out there sort of have a due diligence checklist or have downloaded one from the internet somewhere. I think they're a great starting point, that type of thing. But you really want to have your due diligence list geared towards the business that you're buying, and not just some great big generic 400-point list that a small business seller is going to have almost none of that information. You send that as your first thing you do in due diligence. You send them a 400-point checklist. Your seller's not going to be super happy, pretty overwhelmed, and just sort of create a bit of a negative feeling right away. So having a targeted list that is where everything is of importance to you is, I think, is the way to handle that. So spend a bit of time revising the big list before you send it off to a seller.
Wow, it looks like we missed a few pages, Keith, but we're gonna have
we did.
to let people get back to life.
All right, so looks like we'll have to have one more session anyway.
Yeah.
Yeah. This one flew by. I just looked at the time and I was like, oh wow, it's over already.
I thought we only had like 8 slides. Yeah, my God, I should have looked at that closer. Anyway, yeah, thanks very much, Liz, for your time today, and always great talking to you. Brianne, thanks for hosting.
Same. Thanks for having me on, guys.
Good to
Okay.
see you guys, and thanks everybody for joining us. Have a wonderful day.
Bye,
Bye for
everybody.
now.